Hello and welcome to EBA Day TV. Today we have a special panel for you, and I'm speaking to Martin Thomas of JP Morgan and Peter Hazu of Bank of NY Mellon and Charles Bryant of the EBA. And so we're going to talk about e-invoicing and how that fits in with supply chain finance. So, I think, Charles, we were speaking earlier and you wanted to get into this idea about definition and what supply chain finance is and what does it include. So if you wanted to start off on that.
Yeah, I think my mission is to sort of open up some of the concepts we're working with on some work that EBA has just started back end of last year. During this year, we've created a working group of around 30 bankers and other members, associate members of EBA, to just study the whole area of supply chain finance, building on the work we did on e-invoicing. So very much looking at the way these two products come together. And in that work, we have some issues around definitions, we have issues around risk and regulation, we have issues about automation and the way supply chains are being automated, including e-invoicing, and we have issues on collaboration. And I'm really pleased to have Martin and Peter here to share some of their thinking on this during the course of these few minutes.
Yeah, so do you two want to make a comment on that?
Sure. In terms of the definition of supply chain finance, I would really like to invite you to broaden the perspective on it. Sometimes it's used in and it can be used in a very narrow sense as a product definition. Some people call it reverse factoring. However, when we talk about supply chain financing and e-invoicing, I think it's much more helpful to define it in a sense of a broader concept. And at last year's EBA, Enrico Carinelli gave a very good definition, which was supply chain finance is basically everything that contributes to reduce your working capital that it's bound in your supply chain. I think as a consequence, you started that working group, and I would really like invite people. I think there has been a good paper written on it by Enrico as well as a starting point. Now, when I talk about customers, I would take the end customers, which are corporates for supply chain finance. And if you talk to them, there are two themes that recur on a constant basis. One is they're faced by growing complexity, which is driven not to a small part by globalization, and the second one is the increasing cost in managing the supply chain on their side. Now, I think when we come with solutions to address those challenges, we should always evaluate them against a set of certain characteristics. One is, what is the financing capability that we provide to the corporates that are using the solutions? The second one is, what is the risk management or risk transfer capability of that solution? A third one is certainly, what is the total cost and the process efficiency that you can increase by a solution. And then there are other potentially more technical aspects, like what is the balance sheet treatment of the solution that you provide. Also, what is the tenor and the coverage of the solution that you provide? By outlining these characteristics, I think it's very clear that not a single provider can cover all these aspects. It requires collaboration from technology providers, from financial institutions, and I say financial institutions because for customers, the best way is that you have a collaboration of various financial institutions to make sure that you have true global coverage, that you have the capacity to do that. So global trade networks are kind of necessary for addressing the requirements of those customers. But I stop it here for definition.
Right.
Yeah, I don't want to leave you out, Peter.
Yeah, well, no, I'd like to pick up and actually take two different approaches at this. It is a term, and it's become very topical in recent years, supply chain finance. But actually, the banks have been at various elements of this for quite a long time. There's invoice finance, there's factoring, There's even clean lending to suppliers. I mean, there's many things that the banks
And
have
classical trade
and
finance.
classical trade, not to mention classical trade. So there's many things the banks have been doing over the years in this space. I think that's one of the challenges, actually, is that there is something that about the term even that brings clarity to the concepts. For one thing, there's the physical supply chain, which is also coming in more and more closer association with the financial supply chain. So I think on the one hand, it is good to look at it as a concept of supply chain finance, but there are many elements, of course, which are not brand new, which have been around for a long time and are actually quite deep businesses at the banks. But to bring them into one proposition, one value proposition, one customer proposition, indeed with various product elements, requires some thinking, and of course there's the tradition within some banks of the siloed mentality of this element is there, it's part of the commercial banking, it's not part of this. So there are some internal challenges that directly relate, I think, to the use of the term supply chain finance. So that's I think the starting point for me is not that it's new, but it's something that's coming from many different directions as deep streams that have to become together. The second half of what I'd like to say is relating to, okay, today's world with what's happening in the world, in Europe in particular, as we know, the business models of banks must change. They must find new ways to bring value, partly because a lot of the old businesses are changing. Payments, SEPA, I mean, a tradition, great business. Banks, it's very relevant to customers, will continue to be, but it's not as economic as it was before. So there are many ways that I think banks can serve clients, for example, in the whole supply chain space, the whole invoicing space, et cetera, et cetera. But then what's the driver from the client point of view? There are issues which were mentioned of risk, for example. That's quite topical now. A few years back, before the crisis, we were talking more about operating efficiency and some other things. Today, it's very much risk and liquidity, and that feeds right into this concept. So there's many, as a starting point, this inflection point, there's many ways to look at this and many ways to go, but I'll start by making those two central points, I think.
No, I think that's a really good intro, really good, looking at the definitions from all three of you. And I wanted to maybe keep with you, Peter, for a second, because I think the next question leads, what you had talked about leads into our next question about how e-invoicing sort of fits in with supply chain finance, about is it an essential building block? So maybe you can move on to that.
I'll take the first go and then we'll pass it, I think. On the one hand, there's many different schools of thought. Some would say that the invoice itself is not relevant, material or dematerialized, that you don't need that to do financing. But then it's got many elements to it that I think make it quite interesting. The data elements, the security, avoid even the physical things, sometimes avoiding fraud in certain countries. So it's a way to control things. So I personally, my personal view is it's got quite a central role, though it's quite early in its evolution in terms of the business model and how to support it. The vendors are very active in this space. The banks are somewhat active in this space, I think, but I think it's quite an interesting area and directly links, I think, personally, to the supply chain concept.
I mean, having done the two pieces of work that I referred to, the e-invoicing work over a couple of years, and now trying to bring the supply chain in, there's clearly some propositions in the market, which Martin referred to as, let's call them clear product propositions. But I'd like to be concrete just for a couple of seconds. A large buyer has an important supply chain which may be global. That large buyer is beginning to completely dematerialize that supply chain in terms of orders, invoices, and is looking to work with its suppliers in a collaborative way to ensure that the liquidity is in the right spot, that the supply chain is stable. So this so-called reverse factoring, which actually under the new BAFT-IFSA definition is tending to be called approved payables finance. The supplier sends in an invoice, the buyer approves it automatically, very quickly, based on e-invoicing. The invoice can be financed, the supplier can receive early payment based on a discount. And there's a three-way collaboration there between the buyer, the supplier, and a financial institution. Actually, there's a four-way collaboration because there's often a platform provider that you both mentioned. So that's the kind of structure that's beginning to emerge. And of course, receivables and payables inside the balance sheets of these big companies is the largest stock of near liquidity assets that exist, and the invoice can form a very strong. There are other techniques, of course, purchase order finance, inventory finance, there are letters of credit, bank payment obligation, which SWIFT has been running with. But if we focus on one or two of these things, like the invoice, I think it's very powerful. I don't know whether you agree with that, Martin.
You've had a lot of nodding, so.
Yeah.
Absolutely. I would like to highlight the importance of standardization in that field. As we said, no single solution provider can actually help to put together an end-to-end solution. And I think there have been various successes of standardization in the past, of which EBA has been, part, certainly with your SEPA work and your platform that you introduced very successfully. Now, I think in trade finance, we have also seen some very good standardization in the ICC terms, that for almost a history have been the backbone of facilitating the trade. But in the supply chain finance, as we define it in the broader context, there is definitely still a lack of standardization, and that makes it very difficult to provide solutions that work end to end. And in that respect, JP Morgan is a big proponent of the EBA initiative, and I think that will pay off in the long run significantly for the corporate customers.
So we started off talking about definitions, and then we looked into building blocks. So, I wanted to look a little bit about what are the barriers to supply chain finance. So does anyone want to jump in on one of those first?
I'll have the first go. I mean, the ramping up, the onboarding, it is a change in process somewhat, particularly for the clients and the suppliers, not the least of which because the standards are not yet fully agreed. So each separate provider, be it a bank or otherwise, will have its own approach that it's entering with its own system, its own portal, something. So it's taken a while for supply chain programs, speaking mostly of the reverse factoring, to ramp up. And that slowness to ramp up has been one of the hurdles, one of the impediments.
But talking of standards, the banking industry is very adept at standards through SWIFT, ISO 20022. The e-Invoicing community, which includes, as you say, some banks, but includes lots of other players, are organizing themselves. There are various standardization initiatives here, both of the tax and fiscal regime in Europe particularly, but also in the formats and in the, let's call it the interoperability. So I can see a very rich world being developed just upstream from the payments franchise. So if I were a bank, I'd be looking now strategically and saying, what's all this stuff that's going on above us, if that's the word for it, or upstream of us? We've got a very nice, well-standardized world of payments, but now we see the B2B networks creating this standardized world of supply chain automation. And then the issue is, what role do we play? Do we partner? Do we manufacture? Do we focus on finance purely, or do we finance on the broader range of capabilities that, Martin, you mentioned at the beginning?
So are you talking a bit like sort of payments is the platform?
No, I don't think I am. Okay. I'm saying payments is an adjacency, which may well be linked, but I think the platforms we're talking about adjacent to the payments world are, I would call them B2B networks. Okay. I would call them the dematerialized global automated supply chain networks, which take lots of forms, because we're talking about huge diversity here based on industries and geography. So it's not a pure homogeneous environment, but that's the space that banks have the opportunity, instead of lending against balance sheets and credit ratings, to actually intermediate themselves into these dematerialized supply chain networks.
Talking about barriers, that was your question, and your statement, Charles, that as a bank you would look at trade finance as an attractive field of business. Maybe I would like to outline two key hypotheses that I have. The first one is trade finance, supply chain finance in the broader context is definitely a very attractive market. We see very solid growth in that market. I mean, you know that economists tell us global trade growth is 4% annually, it is very important to also realize that the risk related to that business, at least in the past, has been very low. I think that is sometimes misunderstood, but we participated. I know that the ICC did a study over I think it was the period 2005 to 2009, so it definitely included the financial crisis, working with 9 banks, analyzing trade transactions in a value of about $2.5 trillion US dollars, if I remember it correctly. And the actual default on those transactions was less than 0.02%.
Did it also enter into the Basel III discussion?
Well, and that is a second point I would like to make with regard to barriers. Now, if we accept that this is an attractive field, I would put forward the hypothesis that one of the biggest risks is actually regulation and regulatory arbitrage. Basel III, just to take a major piece of regulation, there are many other regulations that affect it, but Basel III is kind of a cornerstone. And there's definitely a risk in Basel III. Basel III basically wants to reduce the risk, but what the regulation does, and it's a very big regulation. Just recently I had been on a panel where we discussed Basel III. When I looked through the full regulation, just to remind you, the Basel III table of contents and definitions is longer than the whole Glass-Steagall Act of '93. So it's more than 50 pages. You can look it up yourself. Now, and I think and that regulation still needs to be translated into local jurisdiction, basically. And there are 2 major problems potentially with that regulation. The first one is how we treat actually the risk weighting of trade assets. And right now it is assumed that there's 100% risk weighting. And the second one is the tenor assumption, because the minimum tenor that you're supposed to see under Basel III is 1 year, which is way too long for many traditional trade products. By that, the capital requirements stipulated by Basel III will hugely overstate the risk in those underlying transactions. What are the chances of getting some
relief? I mean, do you have a sense of that?
Well, I think that's where we are all required to partner, to collaborate, to make sure that the objective of Basel III, which is a reasonable reduction of risk, is achieved, and we can avoid unintended consequences, which would clearly be to limit and to have a negative impact on the real economy, which is quite real if the regulation comes into force as it is currently stipulated.
I guess also there's an element of the risk which is about good housekeeping. That classical trade finance has a lot of disciplines associated with it, which people are very used to.
And a great actuarial history.
And a great history. Whereas in this supply chain finance, the glossary of terms, the definitions, the market practices, the collateral techniques, the degree of discipline you undertake as bankers when you're monitoring these transactions, these all need to be developed, and that's some of the work that I think is needed at industry level, without it becoming accused of being potentially sloppy. We don't want a sloppy model.
No, I know we could talk for a long time about Martin's bedtime reading, which is very interesting. But I'm moving on from Basel III because I really wanted to end this conversation talking about commoditization, or the word we're not supposed to mention. I spoke to someone this morning that said, no one's supposed to talk about commoditization anymore. It's now value add. So I just, how does this fit into supply chain finance and e-invoicing? I mean, we'll start with you.
Well, I mean, any typical product life cycle begins with a flurry at the beginning, with new entrants, with a lot of excitement, with high potential return, while the market finds the right pricing, et cetera, et cetera. As products mature, they by their nature become more commoditized. That's not necessarily a bad thing. For one thing, it becomes a scale game, the dynamics change, but it becomes a very nice business. So there's nothing wrong with that, and it's been around for a long time, for all of history of products, say. So that's a natural thing. I don't think it's a particularly dirty word, it's just got a different dynamic than what happens early in the life cycle. I do think that the pursuit of value add, another term, but it's about relevance to clients, I think, and that's how, that's I think really what the benchmark of what we're all looking for has to be. What is the value to the clients? They will pay for value, we will make money from value, and that's just a business relationship by providing value. But the whole subject of innovation, which I thought was defined beautifully this morning, about innovation and collaboration, it's not about invention of something new and wonderful. It's a matter of thinking what the building blocks are, including all of that infrastructure that sits at the bedrock, the commoditized bedrock, if you will. But how do we build on those building blocks to make something that is worthwhile, that clients want, that is a good line of business, frankly, from a banking point of view, that also replaces the maturing products that are no longer as value or commoditized, et cetera, where the margin is not as high. Because the market expects us to grow, the banking community is expected to grow, the world needs banks in that sense, and I think that's a quite good way of looking at it, I would say. I think one of the issues around collaboration as a requirement in today's market is that each individual player has got, frankly, limited bandwidth to take on new areas where we can develop value-added products and services. I mean, there's a stretch in terms of resources in today's banking environment because of legacy systems, because of regulation that we discussed. So there's a real requirement, I think, for the banks to work together to figure out, to develop a lot of the standards and a lot of the common thinking, because standalone basis, banks don't either have necessarily the talent, the history, et cetera, et cetera. And this is why a lot of the other merchants, vendors, whatever, are actually going to pursue quite successful paths in this area, which is frankly a traditional transaction banking area. Processing invoices, exactly to Charles' point, through trade finance is in the long history of banking. So why is this new area related to supply chain or related to an e-invoice instead of a traditional e-invoice? Why is that something different? But I do think that it's something the banks need to pursue, but there's been limited time and bench strength to actually go after that area.
Mm-hmm. Yeah, do you want to continue on?
Yeah, with regard to your remark about commoditization, I would just like to point out that I think a commodity would imply that the product, satisfies well-defined customer demand, and I would say we're still far away. The customer experience with regard to supply chain finance and the offering is definitely a differentiating factor. It's still short of what most of our customers expect, and certainly at JP Morgan we put a great emphasis on that. So we believe that is far away from a commodity. I wouldn't see that we are in that space. And the second aspect, I would like to come back to what I said earlier on about the challenges for corporates, and one being the complexity and the globalization. I think in that respect, it's very important for customers that you help them to leverage scale of a global platform, and to provide that global platform and scale requires very close collaboration among various players to provide that coverage. Again, that is something that we value very highly at JP Morgan, where we interact with many partners, and that's where we see the future.
Yeah, so Charles, can you wrap us up and give us a
Okay, well, as I said, I think we've had a very wide-ranging and interesting discussion about what supply chain finance is, how it relates to the automation of supply chains, how it's an essential continuity with traditional techniques of banking, how we have to work in partnership at all levels. I mean, just think of the life of one of these supply chain finance bankers. You have to know a lot of things. You have to know about credit, you have to know about lending, you have to know about risk and return and collateral and legal and technology. So provided those sort of superhuman bankers exist in the market, and I'm sure they do, we can create a vibrant market.